Okay, so welcome everybody to this Zoom meeting about this investment opportunity for real estate. My name is Sean Huang. I am a local investor, also a real estate agent here in Raleigh, Durham, or the Triangle area of North Carolina. I'm very glad that to have you guys here to discuss about this investment opportunity. Before I say anything about this project, I'd like to make a disclaimer that the information that's presented here today is not investment advice. One should not assume that all investments in the project identified here are or will be profitable. This presentation is intended solely to provide information regarding prospective real estate opportunities and nothing more than that. In any event, past performance is not a guarantee of future results, and it should not be assumed that results for portfolio investments will be achieved for other investments. And if there is representative investments presented here today, they're not to be considered a complete list of all investments made or currently held by presenters. So that's my super fine print, and that's my big fat warning or disclaimer to everyone. So again, welcome everybody. And I am very glad to have the general partner for this investment to present to us this opportunity. And they are Javier and also Jason. Now I'm gonna give the presentation, hand it over to, I think, Javier will be running the slides and Jason will be presenting, right?
Yes.
Okay, so let me go back and go back to Javier, and let me make you the host. Okay, hopefully. And let me stop my sharing. Okay, so
perfect.
Go ahead.
All right. Screen one. All right, let me share my screen. Where's my screen one? Here we go. Perfect. Let me know you guys see my screen up.
Yep, I can see it.
Awesome. Perfect. Well, very nice to meet everybody. Thank you, Sean. I'm going to introduce myself, and then Jason will take over. You can introduce yourself, and then we'll move on with the presentation. My name is Javier Hinojo. I'm actually in Raleigh, Durham market, and I've been living in this area for about 20 years. And I have 8 properties right now, 8 apartment buildings, valued a little bit over $54 million, 724 units. And I'm one of the folks involved in this project, and I'm the one that's here locally and have eyes on, as well as, Sean lives here as well. But as we go along, feel free to ask some questions. I have a few questions that I'm going to ask. I'm going to try to get everybody's questions answered, and majority of questions as well. I have them, hopefully we can answer most of your questions during the presentation, and after the presentation, feel free to ask if we didn't hit any of your concerns or questions. So Jason, go ahead and introduce yourself.
Sure. Thanks everyone for taking the time to speak. My name is Jason Keynes. I've been in commercial real estate since the early 2000s. I've been in New York City for the past 20 years. And I moved down to Miami Beach, Florida, 3 months before COVID, which is where I'm based now. The properties we have to speak with you today are adjacent to one another, and they're less than 1 mile from the entrance of Duke University in Durham, North Carolina. As you can see on the first page, the first property is Turayton Square. It's 48 units. 40 of the units have been partially renovated. 8 are in classic condition. And the second property is Garden Terrace. And all 55 of those units are in classic condition.
All right, guys, here's some more disclaimers. I know Sean went over his disclaimer, but these are some more disclaimers for you. And everybody have a copy of this for their records if anybody wants to go back and review it. And just to remind everybody, this is a 506 C offering for accredited investors only.
Javier, could you quickly review what makes a accredited investor for us?
Sure. Accredited investor is net worth $1 million. And you have to, yearly income is 250K.
Thank you.
If you have an income. What did I miss, Jason, on that?
I think if you're married with a spouse, it's 300 and single is 200, but otherwise,
200. Okay.
Yeah.
Perfect. And on the PPM and on documents, it'll break it down for you as well. All right. There you go, Jason.
Okay, so this is the table of contents. We'll briefly go through each point and then we'll do some Q&A at the end. So if we want to start with the executive summary, that's on the next page. So Ashland and Clearview and All States Capital are in contract to acquire these two properties in Durham, North Carolina. They total 103 units. They're adjacent to one another, and it's a value add investment type. And the business plan is to update the units and perform deferred maintenance and bring the rents up to market rent. As you can see, the capital stack is comprised of $4.8 million of equity, $11.9 million of debt for a total project cost of $16.7 million, which equates to $162 a unit. The return metrics that we are projecting for our investors are an 18.8% average annual return. That's over a 5-year hold, an average cash on cash of 7.3, and a 1.94x equity multiple, creating $8.5 million of value. Javier, can you go to the next page?
Yes. Hey, Julie, I see you have your hand raised. Did you need, I'm not sure if you can type something in the chat, Julia, but we'll continue. All right. Go ahead, Jason.
So this is our executive summary. We've identified these two assets, which we're in contract to purchase. Raleigh-Durham, the submarket as a whole, is exploding with growth. Rents in the urban core of Raleigh-Durham were up over 17% last year. These two properties are 1 mile outside of the urban core, so we feel like they're uniquely positioned to pick up a lot of the tenants that leave, who are migrating away from these higher paying rents that they're currently in now. So the business plan is to reconcile and mitigate the results of deferred maintenance by the current owners. We're looking to invest approximately $1 million on exterior renovations and $1 million on interior renovations. That equates to about $5,000 to $10,000 per unit. If the unit is in classic condition, we project about $10,000 to renovate that unit. And if the unit is partially renovated, and many of the units in building number 1 are partially renovated, we project to spend approximately $5,000 per unit to renovate that. A little bit about our partners in the deal. So aside from Ashland Capital and Clearview and Javier, we've decided to partner with Stone Creek Communities, who's going to be our property manager. They're a best-in-class property manager. They have about 1,300 units in North Carolina and another 6,000 in their portfolio, sprinkled throughout the Sun Belt and select markets in the Midwest. And we've structured a $11.95 million loan with Arbor Bank. It's a 3-year bridge loan with 2 1-year extension options at 4% interest. So a little bit about a summary of the project. It's 103 units. Our purchase price is $12.65 million. We project our investors will receive 18.8% per year average annual return, a 1.94x equity multiple, and a 7.3 cash on cash, with a deal level IRR of 17.73%, a deal level equity multiple of 2.16. Total project cost is about 16.7 million, and the total equity required is about 4.8 million. Of the 4.8 million, we have about 3.6. So there are about 12 shares left and about 20 market participants on this call. So hopefully all the shares will be will be invested and spoken for after this call.
So you said, Jason, out of the total equity raised of 4.7-ish, there's about $1 million left to be raised.
Yeah,
Okay.
about 12 shares, so 1.2 million.
1.2, okay.
Okay. Hey, Jason, there is a question from Bill. What is IRR? Can you quickly explain that?
IRR stands for internal rate of return. For all purposes, if you were to think about the moment that you make the investment as year zero, there will be an outlay of cash in year zero. And then we project a 5-year hold, and the sum of all the cash flows that you receive over that 5-year hold divided by the amount of time that the funds were in play is going to equate to that IRR of 17.73% deal level. But the investors' returns will actually be a little bit higher, 18.8%. And that doesn't include the results from the tax benefits, which will also help to add about 2 to 2.5% of yield on top of the 18.8, which is nice because the investors should have over 20% per year.
Thank you.
All right. And the debt service cover ratio, 1.67. That's really good.
Yeah, you may want to explain that a little bit. Why is it
Sure,
good?
I can explain that, Jason.
Sure.
So basically how best way for me to explain this for you guys is for every dollar that the property spends, it's going to make $1.67. That's the best way to kind of explain that. So that's what the bank looks like to make sure that you have enough money to pay your mortgage. But that's a simple way of explaining that. Jason, is there more textbook way to explain that?
No, I would explain it the exact same way. It's kind of just it represents a buffer. So right here, 1.67, that implies that there's a 67% buffer between what the property is taking in and what the property is paying out.
Yeah. So when I borrow money from my commercial bank, they use this as a way to measure how measure the risk level basically on their investment. And every bank uses a different kind of ratio. I have seen mostly between 1.25 and 1.4. I don't know about your experience.
Yeah, it's about 1.25 usually.
Yeah. So 1.67 means they're more buffer financially to cover the debt services.
Correct.
Great. Thank you, guys.
Oh, you're welcome.
So this is an overview of the two properties. Property number 1, Tareton Square, is 48 units. It's a 1969 vintage. Of the 48 units, 40 have been partially renovated and 8 are in classic condition. The property is currently 95% occupied with 95% rent collections, and it's performed that way for the past 2 years, all throughout COVID, which is phenomenal. Property number 2 is 55 units. It's a 1964 vintage property. One really nice thing about both of these properties is that over 90% of the units are 2 beds and 3 beds. And what that means is that the unit sizes are larger. They're about 970 square feet. They're more affordable. And the tenants, there's less turnover in the larger units. Tenants that tend to stay longer. So as an operator and an owner and as an investor, it's always wonderful to see properties that have larger unit sizes and more 2s and 3s as opposed to 1 beds. Here are a few images of both the properties. The image on top is Tareton Square. The current owners have owned it for a few years. They've done some renovations to the properties, but we're really the ones who are taking it through the full value add process, because the rents right now in the market are in the low 800s. And if you were to look at all the buildings that are comparable within a 5 or 6 block radius, you would see that most of the units are renting between $1,000 to $1,300 per month, depending on the property, unit type, and the vintage. So the rents here are really below under market, which is in part why so many of the tenants stayed current on their rent during COVID, and the occupancy in these properties has been so high for a very long time. This is a sample unit renovation. So as you can see, existing units. Seems like we have a question. What prompted the current?
Yeah, what prompted the current owner to sell? Oh, sorry, Jason, I think you're muted.
Okay, I think
There
I'm
you go.
back.
Awesome.
That's a great question. So what prompted the current owner to sell? The current owners met in business school, and they formed a fund, and they acquired 4 properties. And this is the last property that they're selling. They're selling because it's the end of their fund's life cycle. That's a good question. To touch a little bit on a sample unit renovation, the existing unit finishes, as you can see, laminate countertops, the flooring and the carpet is a bit dated, outdated appliances, painted backsplashes, the cabinets are dated. So our business plan is to go in and really modernize and renovate them. And we're not doing any structural work. It's really just all cosmetics. So we're going to be looking to do most likely quartz countertops and modern vinyl hardwood floors, either black or stainless steel appliances. We think that the black may hold up a little bit better. It seems like the pricing between the two are about $100, $125 in difference, but the black seems to hold up better over time. Also, the tile backsplash looks really nice. Premium plumbing fixtures, and we're going to just modernize the cabinet hardware. So this is a sample $100,000 investment structure. So what you'll notice is that the $100,000 gets invested. Year 1, we're renovating the property. So tenants are leaving, new tenants are coming in. We're increasing the rents, we're paying commissions. Cash flow is a little tight in the first year. So we're starting the preferred return in year 2. The preferred return is cumulative, meaning the first year's return gets added on, and all that will get reconciled throughout the holding period. And it's also non-compounding. So in year 2, you can see that the first distribution is made, and those will be made quarterly. And that will equate to about $7,600 in year 2. And then what you'll notice is that in each year following, that amount increases. And that increase is a result of the property performing better, cash flow from operations has increased, and those payments will grow as we get further into our holding period. We projected a 5-year hold, which we think is very conservative. We're seeing other owners and operators execute their plan in sometimes even 3 years or 4 years. We wanted to be really conservative and under promise, and then try our best to over deliver. So what we modeled was a 5-year hold. About 1/3 of the returns are going to come from the preferred return, which is an 8% preferred return. And the other 2/3 of the return are going to come from the sale of the property, which we project selling in year 5. We've touched on the total equity raised and what the returns look like at about 18.8% average annual return. It's about a double on the equity. So put up 100,000, get back 194 and change. The deal structure is It's referred to in the industry as a 70-30 split over an 8, and that's on cash flow from operations, and that's also from a capital event such as a sale or refinance.
Perfect. Next slide.
Sure.
Can I just interrupt for a second? If you go back one slide.
Go ahead.
So there's a question about EQM, also the relationship between that and the average cash on cash. So I happen to see that being listed in here. So EQM means how well your initial equity will multiply at the end of the investment cycle. So in here is 1.94. It means your investment almost doubled at the end of the investment when we exit. If I'm right.
Correct.
Yes, it's about a double. Javier, how would you explain the relationship between equity multiple and an average cash on cash?
I mean, if you just look at the cash on cash, you're looking at a 7.3. So that's what the issue here is 2/3 of the profits are going to come out at the sale, right? So you have 1/3 of that money during the first 5 years, right? It's gonna be about 7.3%. That's a cash on cash, right?
Right.
During the first,
The equity multiple, the equity multiple is really a function of the property sale on the back end. So the cash on cash is during the holding period, and the equity multiple is a function of the sale at the end of the business plan. Hopefully that explains it a little bit.
Yeah, my understanding is the cash on cash only tells you how much cash flow during the operation of the apartment that you are making from your investment. However, the EQM tells you the combination of cash flow plus the capital gain that you earn at the end of the cycle.
at the sale. Yep. So you have 1/3 you'll earn during the hold period, and then 2/3 you'll receive when it's sold.
Yeah, basically there are two ways to make money here. One is from the cash flow. The other is from the capital gain when you sell the property or refinance.
And there are also the tax benefits. So we're going to be doing a cost segregation study to accelerate bonus depreciation. So what that means for a $100,000 investment is that they're going to receive about $50,000 in bonus depreciation. And the majority of that will be received in 2021. So if you're a real estate professional, you can actually use that to shelter active income, which is a phenomenal tool to help build wealth. And if you're not a real estate professional, what that means is that the cash flow from these properties that we pay to you will be tax deferred, which is also a really nice vehicle to help build equity.
Well, thank you guys.
So a little bit about the key financial metrics. As you can see, the capital stack consists of our loan from Arbor Bank. It's about $12 million, and it equates to about 72% of the total project cost. And then the equity that we're bringing in is the balance, which equates to about $4.8 million. Total project cost of about 16.7, which equates to about 162 a unit. And the property directly across the street, which is smaller, it's inferior in every single way, just traded for $175,000 a unit. So we feel like we're in at a very nice basis relative to the property that's sold just across the street.
Yeah, it's not in. It's not going to be as nice as this particular project. So, and it already sold, for $13,000 more per door, and they still have to add $10,000 per unit or more. So, probably more.
So here you can see over the 5-year hold, the business plan is to basically take the NOI and drive it upwards over $1 million. These are very common real estate metrics: cap rate, yield on cost, average yield on cost, cash on cash to investors. So I'm happy to field individual questions. It looks like someone just wrote a question. What's the timetable in terms of acquisition and ready for rent out? So that's a great question. We're closing on this asset in the second week of December. And right now the properties are 95% occupied. So the business plan is, as leases come available, we're going to be having conversations with those tenants, speaking to them, letting them see all the improvements we're making around the property. We're doing the landscaping, we're fixing the parking lots, we're painting the buildings to match, we're giving them an online digital presence and rebranding them, which they don't have good online presences now. So they're run very mom and pop by a management company that's not even on site. There's no on-site leasing, there's no on-site management. So what that creates for the next buyer coming in is a lot of opportunity as you put systems in place to optimize expenses and improve cash flow. Javier, do you want to jump to the next slide?
Yep, there we go.
Okay, so this is a little bit about our high level cash flow projections. As you can see, the business plan is to grow the rents. Right now, the rents are about $825 per month blended, but the submarket is, it's pushing $1,200. So there's quite a lot of room to improve the rents, but the market requires a renovated product. And right now, these properties, they need a bunch of TLC. They need a bit of love put into them, and that's part of our business plan. So as we execute our value add, you're going to see top line revenue grow from $1.2 million to about $1.7 million and change. And we're also going to be optimizing our expenses. And these projections, they've been triangulated by 5 groups: Clearview Real Estate Partners and Ashland Capital, also our lender Arbor, our property manager Stone Creek, and also Javier, who's local and is very familiar and intimate with the local marketplace.
Hey, Jason, talk about the utility and the RUBS. The total rental income right here.
Sure. So
explain that.
The current owners, they instituted a ratio utility bill back system. They haven't reaped any of the financial reward from that, but all the work has been done. So we'll be able to put that in from day one, and that's going to be very helpful in having tenants pick up a portion of the utility spend, and that'll help to enhance cash flow and also reduce our expenses.
Perfect. Let's see. Let me see if I got a question over here. So there's a Bill has a question there, Jason.
Yes. So this will be a stepwise renovation.
Yep.
Keep the current tenants and begin renovation on whichever unit is empty. Sounds right. Yes, exactly. So day one, these properties are 95% occupied. So we have around 5 units to start with. We're preparing with our lender to buy materials in bulk, and we're going to be able to renovate units starting on day one. A typical unit turn takes between 7 to 10 days, depending on the level of work that is required. But we anticipate, and what we've modeled is turning over approximately 3.5 units per month, which, as Javier can tell you, is not very many units. So we think we're very conservative with our underwriting. We modeled turning over 40 units in year 1, 40 units in year 2, and 20 units in year 3, or 23 units. So that's the 103 units. It should take about 28 months to do, but as soon as we get into the property and start work, the goal is to do it as quickly as possible. So hopefully we'll accomplish that in year 2. But we've modeled very conservative underwriting to get you to those returns.
Yeah, that's pretty conservative, because I did one here at the beach, and we did 72 in a year, roughly.
Exactly.
So that was a lot of work, and we did 72 in 1 year.
That's phenomenal. It's very conservative, and I'm very confident we'll be able to do more than that.
Do you anticipate any issues with renovation resources, labor, material?
We're partnering with Stone Creek Communities, who's got 1,300 doors in North Carolina. and all the vendor and supplier relationships and the relationship capital that goes along with that. So we've developed a business plan with Stone Creek and our lender to buy materials in bulk on day one, and we're going to store them close by, and we'll actually have a reserve of materials so that we'll be able to help mitigate against any supply chain issues that are affecting the broader market.
Perfect. Thank you.
All right, the market.
This is just a little bit of detail on the market. Durham, North Carolina was just recently voted the #1 market to invest in the entire country. And that was ahead of Nashville, and that was ahead of Austin. And that is just so exciting to see that Durham is getting recognized for all the wonderful job growth, population growth, and income growth that's going on. Javier, what does it feel like to be a resident in North Carolina over the last 4 or 5 years? What sort of growth have you seen?
Yeah, Durham has been insane. Raleigh, I mean, I live in Raleigh. Durham's 30 minutes away. And probably the biggest shock to me, which is going to sound kind of weird, was about 2 years ago. Some friends of ours asked my wife and I, said, "Hey, you guys want to go hang out downtown?" And I've been here I've been here like 20 years, right? And Durham's always been like the little brother of Raleigh. And my buddy asked my wife and I, "Where do we want to go downtown?" I said, "Sure, we go with you guys downtown." And then his next question was, "Hey, do you want to go to Durham downtown? Do you want to go to Raleigh downtown?" That hit me. Like, I was like, wow, like it just, when that happened, I'm like, okay, it's like Durham has arrived, and it had arrived already. It'd been like 4 or 5 years ago. And just hanging out. If you guys haven't been to Durham, just walk downtown. It's very nice. There's like no chain restaurants. You won't see like a Starbucks. They try to keep it that way. Just very, very local, and they're extremely friendly to development. Extremely friendly. I think at some point they're going to outgrow Raleigh. I don't know when. It might be a while, but they're just doing things that make it very easy to be able to grow, especially for landlords, and being able to raise rents, things like that. There's really no restrictions. There's really no restrictions at all. So
Yeah.
but the market it's super hot. Everywhere you go, there's cranes everywhere. Everything getting built. Offices, warehouses. I mean, it's growing pretty quick.
Yes, just a few small announcements here. You can see Apple recently announced plans for a new $1 billion campus in the Research Triangle, which is about 8.5 miles from these properties. That's expected to create 20,000 jobs. Google has moved in. Obviously, we're less than a mile from Duke University, one of the most prestigious universities in the entire country. We're right near Durham County Hospital, where the average salary is $50,000 a year. So our feeling is we're going to be able to be a preferred housing provider with Durham County Hospital, and I can go offer 3 nurses or 3 technicians a beautifully renovated 3-bedroom apartment, and all they need to do is spend $400 to $500 per month per bed, and we will really, really do well with our returns. Because we've modeled quite a bit more conservatively than that. So if you think about their rent as a percentage of their income, you're talking 12, maybe 15%, where the rest of the country is commonly way more rent burden, between that 30 to 50% mark. So it's very affordable. There's lots of job growth and income growth and population growth, which is wonderful for multifamily rents.
Yes.
Yeah, thank you. I could say something to that as well.
Yes.
Half of my investment portfolio is located in Durham, because I always have a good impression of Durham. And the Durham city started this gentrification project maybe 10 years ago, maybe more than that, and it's been very, very successful. Used to be downtown is a dangerous place to go. But these days it becomes a very, very hip place, and a lot of young professionals would like to live in downtown Durham because of the convenience to work, convenience to attractions, convenience to entertainment and relaxations. So actually, if you drive through downtown On Highway 147, you're going to see a bunch of high-rise condo buildings next to the freeways, and those are being sold at $300-400 or even $500-600 a foot. This is crazy. It's actually being very expensive to live in downtown Durham.
It is. I remember going to the Durham Bulls game, the baseball stadium, and I went back like 3 months later. I couldn't even find the stadium anymore. There was so many buildings around it. I was like, wow, they went up quickly.
Yeah.
So
no.
I actually missed the exit because I couldn't even see the stadium. So
Oh, there's
building.
a question.
Yep.
Sorry, there's a question in the chat room. Can you try to answer that?
Sure. What is the unreturned capital? Is the average cash on cash included in our return capital when the capital event happened? So the average cash on cash is simply the cash flow that the property is throwing off, but the investors are getting a preferred return, which is different than the cash on cash. The preferred return that the investors get is equivalent to 8% per year. And that's cumulative, meaning it grows throughout the holding period. If year one, no pref is distributed, the balance of that will get distributed in the following years. And that will increase, as you saw in that chart, as a result of operations improving and cash flow and property performance improving. Hope I answered that.
Yeah, we have another question, but I think we're going to answer that here shortly in the next slides.
Okay.
From Tong. Oh, here's the universities. So
Yep.
These are the great universities here. They're all within 30 minutes of each other, which is really, really neat. Some of the top universities in the country. Duke University, Carolina State. If you're a college sports fan, especially in basketball, this is the place to be because it's a lot of history here.
Yeah, for those who don't know, UNC, the university in the middle, is the school where Michael Jordan is from.
Yep. Michael Jordan. And Zion Williamson from Duke. There's a lot of yeah,
all right,
a lot of great athletes come out of these schools. NC State. There's a lot of quarterbacks in the NFL from NC State. So playing right now, today, as we speak. The Duke University Hospital. That's another. It's one of the larger employers here in Durham.
Yes, we're actually talking to Duke University's arts department right now. We're trying to get the arts department to make some really cool murals, and we'll display those around the properties, and we may rotate them on a annual basis, and it's going to really make these properties look modern and relevant and really updated. We just got a question from Bill. What is the proposed rent rate after renovation and the anticipated tenants? That's a great question. So what we're seeing in this submarket is that renovated product in 2s and 3s, it's typically renting for like $1,100 to $1,300 a unit. So we've modeled a blended rent of about $1,190. And again, if you think about it on a per bed basis, because everyone's really sharing apartments in this market, in this submarket, you're talking about $550 per month per bed. So it's a very affordable rate. And one of the reasons why we like Durham is because the occupancy rate is like over 96%. So what that means is that every building you go to, they only have a few apartments available. There isn't that much available housing stock in Durham. There's a very big supply demand imbalance, and that's going to work well in our favor once we renovate these properties and we start to release them at market rent, because there's a big housing shortage in Durham. And if you think about today, how unaffordable it is to buy a home or the cost of construction to build a new home, you just have a huge portion of this country who are renters by necessity. And many of them are in C and B type property. And that's why we like this space. We feel like we're really well insulated. when things are not going so good, a lot of your tenants from the B- properties will move into our properties. And when things are going well, you're going to get lots of tenants in that C and C plus portion of the market, which is who our properties cater to. They're the nurses, they're the firemen, they're the policemen, they're the post officers. They work in manufacturing jobs and retail jobs. They're involved in the healthcare system and government. And that's who's living in these properties as we reposition them and improve the tenant base.
Yeah, I can add something to that because I have rental properties in Durham, and I just rented a 3-bedroom apartment to a Section 8 tenant, and the government pays $14.23 for the 3-bedroom.
Wow.
Yeah.
That blows away my pro forma.
Well, I cannot guarantee, but compared to what you're going to renovate, my unit is like worse than the one before your renovation. So I have good reason to believe that these will rent at similar rates. So 2 bedrooms will go for between $11.50 and $12.50. It depends on the location. And these 2 apartments location is actually much better than mine. So I believe those numbers are reasonable in your estimate.
Yeah, I think they're good, really good numbers.
Mm-hmm.
What are the security measures for tenants? That's a great question. Durham is gentrifying. So security measures, we're doing, we have some cameras installed to give tenants peace of mind around the parking lots. We're improving the lighting where at night, if you're walking to your car, it isn't as dark. We're going to have on-site leasing, which is huge. Right now, these properties have no on-site presence. Literally, if there's an issue, there's no one around to fix it. So we're going to have on-site leasing and on-site management, and we think those will be very well appreciated by the tenant base. We're going to be able to offer a much higher level of service than the tenants are used to receiving.
我说的意思是，因为像你旅馆就特别脏，我跟你讲，然后结了冰，你现在至少是干得干干净净的，这样子。
All right. Jason, did I mute you or no? You're good?
I think I'm okay. Can you guys hear me?
Yep.
Great. So these are some comparable rental properties in the neighborhood. In addition to these, we have plenty of others. You'll see a lot of the vintages are in the 60s and 70s and some early 80s. And a lot of the units are very small. And a lot of the properties are small. This submarket is owned by, I would say it's highly fragmented, meaning it's owned by lots of mom and pop type sellers. Even though there's been a ton of institutional interest in Durham in the last few years, that's mostly the high-rise product that gets built, the Class A stuff that rents for multiple thousands of dollars per unit per month. Our strategy is to really target the 60s and 70s type product where it needs a bunch of TLC, but once you renovate the interiors and you clean up the outsides, the properties look wonderful. They're safe, they're functionally, they're modern, they're relevant, they're clean. They're near public transportation. They're near the YMCA. They're a mile to downtown. You can get in your car and within a few minutes drive, you can be at a WeWork. So it's very unique and it's exciting. And the campus near Duke University is absolutely gorgeous.
Hey, Leo asked a question. What if the current tenants won't agree with the rent increases?
So we anticipate probably about half the tenants over time will migrate to other properties. And that's part of our business plan, is that we're really looking to attract tenants from outside our current tenant base. So
that's the way it usually works.
Yeah.
Usually a good portion are going to go, and some of those you probably don't want because they might not even qualify for the new rents.
Exactly. The current management has done a pretty poor job with record keeping, and there really aren't great systems in place. So our property manager, Stone Creek, is very excited to input their systems and their measures, and they anticipate dealing almost exclusively with the larger tenant base, which most of it will come from within 3 to 4 miles of these properties. These are some comparable sales that have occurred. So Durham as a whole, 44 apartment complexes have traded in the last 12 months, and they've been at an average cap rate of 4.1% and an average price per door of $197,000. Now that encapsulates everything from C class to A class. If you look at this particular niche of property, and our business plan is to really take a C and turn it into a C plus, B minus. The property right across the street, Parkway, just sold for $175,000 per unit, which is just, it's wild. We've modeled selling at $200,000 a unit 5 years from now. So if you think about all the time we're going to have to renovate apartments, to increase the income, to decrease the expenses, and to grow the NOI. And obviously we're in an inflationary environment, and everyone knows that inflation is good for multifamily rents. So we think our numbers are conservative, and we think they're defensible.
Hey, let's talk about inspections, Jason.
Sure.
Let's talk about inspections, structural inspections, who did the due diligence? What did you guys find?
Sure. So we've been working on these properties for about 90 days now. One really nice thing, we have one of the most talented engineers in all of North Carolina on our team. And we also have a gentleman who owns one of the largest third-party construction companies involved in this. And they're both intimately involved with these properties, and they've both worked on them for many years. So they're very familiar with these assets. And we've also had multiple property managers. We interviewed 5 companies. We started with the company Wellington Advisors, who's very well known in the market. We spent money with them. They went in, they did a full due diligence. We spent many thousands of dollars with them. And as we continued to interview property management companies 2, 3, 4, and 5, the 5th company that we found was Stone Creek. And in our opinion, they're really best in class. And we went with them for that reason. And they can't wait to get their hands on these properties. So our lender has completed all their inspections. Our lender has completed all their third-party reports. So from a reporting and due diligence perspective, these properties are ready to be closed on.
Hey, Jason, let's talk about all the money that's already been spent, just getting all the reports, getting everything ready to close. How much money are the GPs putting into the project?
Sure. So the GPs are investing 10% of the required equity. So on $4.8 million, $480,000. And in addition to that $480,000, we've also spent another $300,000, and that includes deposits and due diligence and reporting and all the work that we've done over the last 3 months. So we're in for about $800,000. So we've got a lot of skin in the game.
Perfect. All right, so let's talk about the general partnership team.
Yes. So Ashland Capital is led by Alex and Eric Hogan. They are helpful in securing the acquisition debt. They are leading asset management. They are leading due diligence. Clearview is bringing the capital, and we sourced the deal. And Javier is our boots on the ground partner who has intimate knowledge of this. And he's going to be a tremendous role in just being able to put eyes on the property on a daily and weekly basis.
I don't tell many people this, but I have a general contractor license. Just don't tell anybody. Don't tell nobody. Sean, don't tell nobody.
This is a little bit about my entity and
Here
my
we go.
two partners and Ashland, and you can read that. But our business plan is to target these 100-unit plus B and C complexes in the Southeast. What we're seeing is we're really just front running trends that already existed, but were just accelerated by COVID. We're seeing people leave dense environments and go to the suburbs a little bit. These properties are about 1 mile outside of the urban core, so they're not quite suburban, but they're well positioned to pick up the people who maybe leave downtown Durham because they're tired of spending, $1,800 a month in rent, and they want to find something for 12 or 1,300 a month instead. And we'll be able to offer them a beautifully renovated product very close to their job.
All right, that's me right there. So I'm in. I introduced myself a little bit earlier, but this is all my portfolio that I own right now, and we actually do the asset management for every single one of these except for the Farms of Goose Creek, which is the one in South Carolina, that's 63 units. But for everything else, we do the asset management, right? I actually have a full staff. I also have a director of acquisition and a COO. He does this asset management. So I have plenty of experience managing assets. So just being boots on the ground, being here local, knowing the market, and partnering up with Jason and Guy, and with Alex and Alex's son, with Ashland Capital. This is pretty strong management team. I believe Ashland has like 150 million EM properties. Yeah, here we go.
I honestly, this is a little old at this point. They're approaching 200 million.
Okay.
So between you and Ashland alone is $250 million.
Perfect.
These are some of Ashland's recent acquisitions, properties in Texas and Georgia and South Carolina, and Arizona, Iowa, Arkansas, Georgia. So they're very active market participants. They've made about 7 acquisitions this year, and they've also sold about 2 properties. They have 1 more that's selling by year end. So we're really excited to be partnered with Ashland and with Javier, and we're hoping this is a programmatic relationship. And our business plan is to go take down a few of these per year for the foreseeable future.
Hey, Jason, Bill asked if they can see some of the inspection reports.
Absolutely.
So we can get with Sean and Bill.
Yep.
Get you
Bill
that
can
if you need that.
Bill can write Sean an email and we can respond in the email. And I've got Dropbox files, so sure.
Hey, so yeah, I think that a $2 million budget is pretty good. That averages out to about $20,000 per unit, give or take.
Yeah,
That's a really, really good budget.
It's pretty healthy.
Yeah, really good.
Ashland's is renovated close to 2,000 units. They're typically spending, $4 to $6 grand a unit. We're averaging at about $8,000 blended per unit. So we've got plenty of room in our numbers. And again, these building number 1, the units are in pretty good shape. Building number 2 is the heavier lift, and it's going to look phenomenal when we're done with it. It's got some really charming features.
So you guys are going to do both external and internal improvements.
Yes.
Okay.
A question, how many GP in total? So it's myself, it's Javier, and it's Ashland Capital. So there's 3 companies, and that's of huge benefit to the investors because we share our resources, we share our underwriting, we share our relationships. So our investor base is getting the benefit of 3 sets of eyes on this deal as opposed to just 1. So we think that's pretty exciting for our investors.
Mm-hmm.
I'm gonna ask you a few questions, Jason.
Sure.
One of the questions is from, I think it's let's see here, Long. He wants to know from Tong. He says, I know how the LPs make money. How do the GPs make a profit? So how do we make money? Right? We got a 70-30 split, and the LPs get 70%. So kind of explain that a little bit.
Sure. So the deal is structured 70-30 over an 8. And what's nice about this deal and the way we structured it from the LP's perspective is the GPs don't make a dime until the LPs have received all their capital back plus an 8% return. So everyone's really aligned, and it's in the GP's interest to get the LP's capital back as quickly as possible.
And that's written out on the PPM, the private placement memorandum,
Yes.
which we can share with you guys. It's a fun read. If you guys have about an hour, it's a good read. So I got a few more other questions.
Sure.
Let's see. Okay. You already did the comparables. Are the units, okay, the units are currently rented. Is there any increase in rental? Yes, okay. Or any local laws prevent from rental increase? Like if we go from like 800 to 1100 or 800 to 1300, is there a local laws like rent control?
No, and that's one really nice reason that we're targeting North Carolina and in this submarket specifically. These are market rate apartments, and the market is clearly, $1,100 to $1,300 a month, but that's for renovated products. So our responsibility is to go in and renovate these units and bring the rents to market. But no, there's no local law about market rate units and what you can charge. It's what the market bears.
Okay. Another question is between the GP and LP equity, which is inferior / superior, or are they treated the same if there's any loss?
Yes, so they both sit in the same exact bucket, and they're treated exactly the same.
Could you
Okay.
quickly go over the liability difference between GP and LP, just so that we know?
Sure. The LPs are only liable up to their investment, and for that to happen, our break-even percentage would be, the properties would need to be under 65% occupied. These properties have been 95, 96% occupied for years. So that will never happen. What was your second question?
The liability for the GP.
The liability for the GP is quite high. We're signing on the debt. It's non-recourse debt, but I'm putting my reputation and a whole bunch of capital into this deal. And it's also a friends and family deal. So I have my family, my mom and dad are invested in this deal. My partners, the same thing. A lot of their friends and family are in this deal. So from that perspective, we have a lot on the line, which should be comforting to investors.
How is the track record of the property management company?
So Stone Creek is phenomenal. They've got over 7,000 units. 1,300 of them are in North Carolina. They've turned over thousands of interior units in the last 24 months, and they're phenomenal. So they're going to be leading the value add process and the day-to-day, and Javier is going to be working very closely with them as boots on the ground.
Yeah. So I'm sure they have some really good crews, if they need any help, I've got plenty as well. So
Javier, are you going to be the boots on the ground for this?
yes.
Perfect.
So I'll be eyes on the property, making sure that everything is going on track.
Mm-hmm.
So, I report, to the GPs. So, I don't report to the property management company or the construction company is doing the work. I report to all the GPs, everything that I find. So that way we can make sure that everything is on track. Whatever the property management company or the contracting company says they're doing, I make sure that it's getting done, not just getting, somebody else opinion, right? We'll get 2 or 3 different reports, right, from different people. So it's a good way to manage a project.
Great.
Especially being a general partner, which I'm part owner, so that's really good because it's it's also, our property. So we got to make sure that it's going smoothly.
Mm-hmm.
Let's see here. Depreciation. We talked a little bit about accelerated depreciation. Does anybody have any questions on that? Like in more in detail? You can put it on the chat, but I'll just kind of go over real quick. I know Jason hit that. You have to be classified as a real estate professional. And if you don't know if you're classified as a real estate professional, ask your CPA. If you are, you're not. And if you are, you're able to take some of those losses or some of that depreciation to some other income. Okay. If you're not a real estate professional, you can take say you get involved with $100,000, you'll get about $50,000 in tax credit. So if you're at a 30% tax bracket, state and federal, just say 30, you save yourself $15,000, right? If you are considered a real estate professional, that's what you save yourself that year, 2021, in taxes. And if you're not a real estate professional, any money that you made from the property, you're able to subtract, up to $50,000. So basically you won't pay any taxes on that the first, for a good while. Maybe not at all. Right. But I'm not a tax professional, consult your CPA, but did I explain that? Anybody have any questions on that?
Nope, that was perfect. The cash flows that our investors receive will be tax deferred.
Lon wants to know who's going to run the project, or the key person running the project.
So operations is led by Ashland, and Ashland's going to work very closely with Javier and myself. So we really have three sets of eyes.
Yeah.
In addition to the lender and the property manager.
Yep.
So it's really 5 sets of eyes on this thing.
Yep. Who is Ashland in the lead? Who's Ashland lead person? It's going to be
Alex
Alex right here. Alex right here.
This has over 500 million of transaction experience. He was a very successful builder, sold his company, went into multifamily, and is growing very quickly. Yeah, he's acquired about 7 properties this year.
Yep.
There's a question whether the return is fixed or flexible.
So the return is fixed. We're going to be paying our investors an 8% preferred return, and that's cumulative, and it's non-compounding, and it accrues. So anything during the holding period that hasn't been paid will get paid to the LPs before the GPs take a dime. So again, it's all about the LPs getting their money back plus their return before the GPs participate.
All right, let's see here. And you talked about the property management companies that you did interview 5 of them. So that question is answered. Do the GP track records show returns with similar projects in the last few years?
Yes.
So I can speak for myself, and you can speak for Alex, Jason, if you like, but
Sure.
I'll give you my overview here on these projects. And if anybody wants more information in detail, feel free to reach out to on an email with Sean and myself. Include Sean, please. Every one of these projects that I have, well, Central Oaks, the one at the bottom of 34 units, we just bought a couple of weeks ago in right outside Charleston. But everything else here, we're averaging around a 9 to 10% cash on cash right now. And we got a couple here, the townhomes apartments in Havelock, North Carolina, right? We're actually doing our refinance right now. And once we do that, it'll be about a 25% total return on that particular project. And also on the one in Houma, Louisiana, 123 units. We're starting the refinance process as well. And that's also going to hit about a 23, 24% total return. And actually these two right there are hitting about a 10% cash on cash return so far. So I've got some projects that have exceeded these returns. So, hitting these returns should be, it's actually one of the easier projects that I've actually done. So.
No, that's great. Javier, you've been doing a phenomenal job for your investors, and Ashland has been wildly successful as well. Their most recent sale was in Atlanta, Georgia. It was a C-class apartment complex, 152 units, and the net result was a 25% IRR to their investor base. So what we always like to say is it's a little bit of a curse doing that well. You're a little hesitant to share it because you don't want to overpromise and underdeliver. But what I can say to the investors who are listening is that we've been very conservative in our underwriting. For example, for taxes, we underwrote a tax reassessment at a worst case scenario. We took 100% of the purchase price and multiplied it by the local millage rate to get a big increase in taxes in year 2, which we've underwritten for. But we're also consulting with a tax advisory firm who thinks that we'll be able to protest the taxes and knock it down quite a bit. So there's all different sorts of levers that we've kind of put inside our underwriting and inside this business plan that are going to help us to, I believe, over deliver on our returns here.
All right here. So somebody's asked a question on what if the renovations takes way longer than expected, considering supply chain issues and shortage and everything. I know you mentioned that earlier. We're going to order in bulk.
Yeah,
And,
so
yep.
we've underwritten this deal with a 28-month construction and stabilization timeline, which is very conservative for this size of a property. It's only 103 units. So on average, we would need to renovate 3 to 4 units per month to get everything completed in just over 2 years. And again, our plan is to order our materials in bulk on the day that we close. So as soon as the units vacate, we'll have the materials on hand to complete the renovation. And our team is going through 3 separate projects just like this at the moment. Ashland Capital has 3 of these going on right now.
What kind of conditions will LPs lose their investment?
Sure. So the property's occupancy would have to drop to 65% for us to lose money. And these properties are 95% occupied, and the market has experienced 20% population growth in the last 10 years. And that growth is not going away. It's only accelerating. So the short answer is a lot would need to go wrong. We don't think there's any chance of these properties being 65% occupied. They're currently 95% occupied.
All right, we got a couple more questions.
Sorry, I just want to quickly add to that. So in my experience these days, there's actually for every unit that my company or myself listed for rent, there's multiple tenants competing for one. So the rental market is it's in a great imbalance between supply and demand as well.
And it's gonna be like that for a while, especially here.
Yeah, there is a shortage, especially when it comes to the affordable housing side of the market. It's even worse.
Yep.
And this
Exactly. If you're buying a piece of property today and you're building a new structure, you're not building affordable housing. You know, you're building B+, A- type housing that's going to rent for thousands of dollars a month.
All right. What if the property, we got a couple more questions and we'll wrap it up. And what the property won't sell in 5 years? Will it become a 10-year hold?
Sure, that's a great question. So what's really nice about our debt is that it's bridge debt. It's a 3-year loan with 2 1-year extension options. And the best part about it is that there's only a 1% prepayment penalty. So there's no yield maintenance, there's no defeasance, there's no scenario in which we go create $4 million of profit and then it costs us millions of dollars to exit because of a prepayment penalty. So that's not the situation at all here. We have a 1% prepayment penalty. With regards to what happens if the property is hard to sell after 5 years, we can refinance the loan into long-term floating rate debt with a flexible prepayment option. We can cash out a portion of our equity. We can return it to investors, and we can hold the property and wait for a better time to sell.
Perfect. Maintenance and measurements for how we're going to measure the management performance and like the maintenance.
Sure. So what's really nice here is that the management team is compensated as a percent of the effective gross income. Therefore, incentives are aligned between ownership and management. The better the property's performance, the more the management company earns in fees. That said, we have daily communication with the on-site team to ensure our business plan is being executed properly. Ashlyn and Javier, everyone has long, successful track records of working with third-party management firms and holding them accountable for their responsibilities.
Perfect. And that's how we're going to adapt to the economic cycle, right? What if, that cycle is over in a few years?
Sure. So the debt package that we structured, it allows us to be flexible and opportunistic with a potential sale or refinance. So starting in year 3 of our operations, we can begin to evaluate an exit depending on market conditions. If the market doesn't dictate the sale in year 3, we can extend our loan for an additional 1 or 2 years, 1 year at a time. Come year 5, the loan will mature. And if we don't sell, we'll refinance into longer term debt, cash out, and return a portion of the investor equity and continue holding the property for cash flow.
Perfect. Jason, you did a great job. Appreciate everybody else being on here. Did anybody else have any other questions that we missed? Sean, any question that you see that you think we might have overlooked, or any other anything else you want to ask?
Did you already go over all the questions that I sent you?
Yep.
It feels like it.
Yep. We hit every single one of them.
Yeah. And everyone, if you have questions, feel free to raise that in the chat room. I guess we have time for a few more.
Yeah, we can answer a few more for sure.
Okay. And can you talk about the deadlines for participating in this project?
Sure. So we are pretty far along in our capital raise. We have around 12 shares left. So what we're requesting is that any investors who are interested sign the docs and wire their funds by next Monday. So they have just over a week.
On the 29th.
Yes.
So not this coming week, but the following week.
Yes, the
Perfect.
29th, next Monday.
Leo said, sorry, I missed the beginning. That's okay, Leo. What is the total estimated return and what is the guaranteed return again?
Sure. So the estimated return is 18.8% per year. And that doesn't include the cost segregation study, which is going to enhance those returns a few percentage points. So we think you'll be north of 20% per year. And the guaranteed return, I think what you mean by guaranteed is the preferred return. That's going to be 8% per year, and that'll be paid quarterly to investors.
Starting in year 2.
Starting in year 2.
Okay. So one third of your returns are going to be during the hold of the project, and 2/3 when we do the sale.
Yes, and we've underwrote a 5-year hold, which we think is very conservative. I think there's a good chance of doing something in year 4 or sooner. It's a function of our unit turns, which again, we've been very conservative, underwriting about 3.5 per month. And we're excited to get in there and start turning over units and renovating. Sean, is there anything else you'd like to touch on?
Another question. Actually, we got long. It says, how do you manage renovation budget going out of control? Do you use a binding contract?
Yes, that's a great question. So we do use contracts that are receiving bids from multiple parties. We've bid out pretty much all the work we're going to do. Javier, how do you approach that in your renovations?
So I'll give you an idea. So you know, somebody can give you a guaranteed bid, right? But if they open up a wall and all the electrical wire is missing, you know, you know, and all they're gonna do is just plug in some outlets, and there's no electrical wire. Well, that's not a guaranteed bid, right? They always have an out, you know, or for surprises or any kind of contingency or any kind of change order. So ideally, you want to get enough estimates from different people where you kind of know what it's going to cost to remodel an apartment building. I mean, ideally, it's so much easier to, like, I used to flip a lot of houses before I bought apartments. I would flip like 50 houses a year in Raleigh and Durham area. You only have certain costs. It's so much easier to remodel an apartment building because they're all in one location, and maybe you have 2, 3, maybe 4 different kind of units. Okay. And everything's the same. The floor's going to cost the same. The paint's going to cost the same. The toilet's going to cost the same. The countertop's going to cost the same. You know, the material might fluctuate right now, but the major problems you're going to have is like your plumbing, right? You know, if you don't scope the line to check, you know, the line all the way from the building to the city sewer hookup, that could be very expensive, right? If you don't check your electrical, that could be very expensive. If you don't check your roofs, that could be very expensive. So there's only a certain amount of things that can be, you know, that can really go out of control. But you know, if you check everything, there's you know, it's really challenging for it to go bad. You know, if everything's been checked the right way, like it has been, it's something's got to happen where everybody missed it. So unforeseeable events. I mean, I wish we all had a crystal ball, but I think a $2 million budget for this building is actually really good. I'm doing a 208 unit in Tulsa, Oklahoma, and we spent about 2.4 million, and it was not in very good shape. It was pretty bad shape. So, $2 million, I think that's way more than enough.
Yeah, we've budgeted for cost overruns, construction management fees. We've got a big budget, so we've got big reserves and a strong cash position.
Can you? I got one last question. Sorry.
From
Yep.
Linda. Can
Go
you
ahead.
reclassify the depreciation or reclarify?
Clarify.
So we're going to be doing a cost segregation study to accelerate bonus depreciation. And what that means for, let's say, a $100,000 investor is they're going to receive $50,000 of bonus depreciation, and that's going to be received, the majority of which will be in 2021. So if you're an active real estate professional, meaning you work over 15 hours a week in real estate, you can actually use that depreciation to shelter your active income, which is amazing. If you're not a real estate professional, the future cash flows that will be paid out from this project to you, the investor, will be tax deferred until there's a depreciation recapture when we sell the property. And at that time, your profits will be taxed at capital gains instead of ordinary income. So that's why this is real estate in general is a very tax efficient way to build wealth. So that's a big part of our business plan. I hope I explained that. Does the GP get any fee for the debt loan with the bank? No, the GP doesn't get any fee with the bank. Does any GP have a construction company that will bid for the renovation? Yes, we've got multiple groups, multiple bids on every line item in this project. And Stone Creek, our property manager, is leading that process. And Ashlyn and Javier and myself are overseeing it alongside Stone Creek. So we've got plenty of bids for every line item.
I have a quick question.
Sean, go ahead.
For the exit strategy, there's 2 options: either cash out refinance or sell the property. Which way are you more likely to go? What will be the decision making point?
So right now we've modeled repositioning this property and selling it on a 5-year hold. There's a very good chance we can refinance this property in year 3. But it's a function of where capital markets are, where interest rates are, where loan to value ratios are. So as we get into our business plan, we'll see where the larger capital markets are, and we'll really let that dictate what our next move is with regards to either refining or selling.
Okay, thank you.
All right, looks like we don't have any other questions. Thank you, Sean, so much. Thank you, Jason. Thank you, everybody, for being on this call on Sunday. I know
Mhm.
everybody's busy, and I do appreciate when somebody gives us their time, and very grateful for that. Thank you very much. Just like Jason mentioned, we are closing next month. So anybody who wants to get involved, please reach out to Sean so we can get you over the documents, the PPM, which is the private placement memorandum, which you would read and you would sign. There's some places for you to sign, and all the information will be there for where to wire the money, et cetera. If you're going to invest, as an individual or an LLC, I know everybody's going to have some questions like that, and we can take them offline, so we can let everybody go on their day. We have a little bit over $1 million left for this project. It is a first come, first serve basis. So, the money's wired, documents are signed in the account, you do get your spot. And did I miss anything there, Jason, Sean?
No, I mean, our last investor who came in was for 700,000. So that million could get taken, but it's first come, first serve. If you're interested, please reach out to Sean, and then Sean will connect you with Javier and myself, and we'll hold your hand and take it from there.
Okay, so each share is 100,000, but you could buy multiple shares if you want to, correct?
Yes, correct.
Okay, thank you, guys. Well, thank you, Javier. Thank you,
And,
Jason.
and if anybody needed to do a 50K, I think our PPM says 50,000. Just reach out to us.
Oh, that's good news.
Yeah.
Okay,
Yes,
that's
if
good.
anyone wants to come in a little smaller for 50,000, depending on how quickly you are to respond, we can try and figure out a way to work you into the deal.
Correct.
Okay. Okay. All right. Thank you, gentlemen. Thank you both for so much for your time and the presentation of this investment opportunity. Like I said, any investment comes with risk, so everybody make your own decision. Personally, I think it's a great opportunity. I haven't seen that for a while in this market, so I am very interested as well. So if you have any questions, feel free to contact me. And I know I'm recording it, so once I'm finished, I will share the recording with other people who, if they ask me privately, so they can take a look at this recording. All right,
Thanks
so
again.
if no more questions, I'm gonna end the meeting. Thank you, everyone, and have a great weekend.
Yes,
Thanks
have a
so
great
much,
weekend, everybody.
everyone. It's an honor to present to you, and we're excited to have you on board as investors in this exciting project.
Have a great weekend, everybody.
All right, thank you. Have a great evening. Bye-bye.
Bye-bye.